Welcome to the deep dive. So, you sent us some really interesting source material asking us to unpack a really key concept in stock market trading: volume analysis.
Yeah, volume. You hear the term thrown around all the time, don't you?
Constantly. It's absolutely fundamental, everyone says that, to understanding market moves.
Hmm.
But maybe sometimes it just feels like, another line or bar on the chart that doesn't really mean much.
Right. Or its meaning isn't quite clear. It's sort of like the market's hidden language, isn't it? It's telling you how much energy, how much conviction is actually behind a price move.
Exactly. And if you don't understand that language, well, you're missing a pretty big part of the picture.
A huge part.
So our mission in this deep dive, and we're pulling directly from the insights in a YouTube video transcript you shared, is to try and make that language crystal clear.
Okay.
We're going to cut through, hopefully, any confusion, show you exactly what volume is, how to read it, and maybe why it's even more important than just staring at the price action alone.
Yeah, getting beyond just the price ticks.
Think of this as, I guess, getting the core actionable intelligence without getting totally swamped in data.
Sounds good. Okay, so let's unpack this then. At its most basic level,
hmm
what exactly is volume when we're talking about stocks or trading?
Well, it's actually pretty straightforward when you boil it down. It's just the total number of shares or contracts if you're trading futures that changed hands.
Right, bought and sold.
Exactly. For a specific thing, like a stock or an index future, within whatever time frame you're looking at on your chart, could be a 1-minute chart, an hourly, a daily.
Got it. And here's where I think one of the first really important points from our source material comes in. It tackles a super common misconception.
Oh yeah, which one?
Well, a lot of traders think, okay, the price is rocketing up. That must mean there are just way more buyers than sellers. But, well, that's not actually how it works.
Right, I remember thinking that way back when. But yeah, for every single share that gets bought, somebody had to sell it.
Precisely.
Yeah.
And vice versa. For every share sold, someone else had to buy it. A transaction needs both sides,
Yeah.
always.
You can't just buy from nowhere, and you can't sell into a vacuum.
Exactly. So volume isn't really telling you about an imbalance in the number of buyers versus sellers. What high volume actually signifies is the intensity of interest, the level of participation from both sides, buyers and sellers, right there at that price level at that time.
Okay, so high volume means lots of activity, lots of engagement from everyone involved.
Yeah. Think about that sweet shop analogy from the source material. It's pretty good.
All right, the shopkeeper's always there selling sweets. That's just normal business.
Exactly. But if suddenly, instead of just a few people trickling in, there's this massive queue right out the door, everyone buzzing, buying sweets.
The shopkeeper is still just selling, same as before, but the activity, the sheer interest level has just exploded.
That's it. That increased activity, that high participation from both the buyers queuing up and the seller. That's what shows up on the chart as high volume. More transactions happening.
More engagement. Got it. And on our charts, we usually see this where down below the price bars.
Typically, yeah.
Mm.
As those vertical bars in a separate panel at the bottom. Taller bar just means more volume traded during that candle's period.
Now, the source also mentioned something practical, especially for people watching indices like, say, the Nifty or Bank Nifty here. You don't usually see volume bars directly on the main index chart itself, do you?
No, you generally don't, because the index itself is just a calculated value, right? It's based on a basket of underlying stocks.
So where do you look for the volume then?
The actual collective trading activity, the participation, that's reflected in their futures contracts.
Ah, okay. So you'd pull up the chart for Nifty futures or Bank Nifty futures and look at the volume bars there.
Exactly. And as the source notes, you'll see different expiry dates for those futures contracts you can choose from.
Okay, right. So that's what volume is, the amount of trading activity and where to find it, even for indices. But just seeing a big bar or a small bar, that doesn't tell you much in isolation, does it?
Not really. The real key, and the source emphasizes this really well, is how you interpret it, how you make sense of it.
And the secret sauce there is
Comparing the current volume to its average, that's the game changer.
the average. Okay, so that's the benchmark. What's considered normal activity for this particular stock or index future over, say, the last 20 periods or whatever the setting is?
Exactly. And you usually see that average plotted right there with the volume bars. It's often a moving average line running across them.
Makes sense. The source used that Virat Kohli batting average analogy, which I thought was quite neat.
Yeah, it works well. If his usual average score is, say, 30 runs, then him scoring 50 is a great performance for him. It's significantly above his average.
But if he scores 10, well, compared to his average, that's low, not his usual performance.
Right. So applying that to volume, significant or high volume doesn't just mean a tall bar in absolute terms. It means the volume bar for that specific candle is sticking up above its moving average line.
Okay, so it's higher than usual participation, more interest than normal.
That's the signal. And conversely, low or shrinking volume simply means the bar is below that average line. Participation is less than usual for that period.
Got it. That comparison is everything.
It really is fundamental because
Yeah.
once you grasp that comparison,
It unlocks that core framework from the source, right?
Yeah.
Those four key scenarios that combine price movement with whether volume is above or below average.
exactly, these are like the four basic signals the market's giving you through volume.
Okay, let's walk through them. Condition one, price is going up. A&D volume is also going up, meaning it's above its average.
Right. So what's the interpretation here?
The source says this indicates a strong bullish trend. It's not just price drifting higher on fumes. The rising price is being actively supported by unusually high interest, high participation.
Buyers are keen and sellers are meeting them, but the activity level is high. There's real energy, real conviction behind that upward move.
Okay, makes sense. Condition two, price is going down, A&D volume is going up, again, above its average.
Same principle, opposite direction. This points to a strong bearish trend.
So the falling price isn't just happening passively, it's happening with high participation, high engagement, lots of trading activity as it drops. There's conviction in the downward move, too.
Exactly. The trend, whether up or down, has power behind it when volume is high.
Now, here's where it gets maybe more predictive, looking for changes. Condition three, price is going up, BUT, the volume is shrinking, falling below its average.
Now, this is interesting. The source flags this as an early warning sign. It suggests a weak trend.
Why weak? Price is still rising.
Yeah, but the interest, the participation, just isn't keeping pace. Fewer shares are being traded compared to normal, even as the price ticks up.
It's like that sweet shop queue shrinking again. Even though the price sign keeps going up slightly, it feels unsustainable.
Exactly. It suggests the upward momentum might be running out of gas. The conviction isn't there in the same way. How long can it keep going if fewer people are involved?
Okay, a potential reversal warning. And condition four, price is falling, BUT volume is shrinking, falling below average.
Same logic, just flipped. Also suggests a weak trend, and it's also a signpost for a potential reversal.
So the price is dropping, but the participation, the number of shares changing hands, is lower than usual. The conviction behind the downward move is fading.
Right. The selling pressure might be drying up. It could be running out of steam.
Wow, okay. So those four conditions, they're basically your fundamental lens for reading the interaction between price and volume.
Pretty much, they give you a framework. Now, let's think about how this actually plays out in specific trading scenarios the source mentions, like breakouts and reversals.
Yeah, breakouts and breakdowns, huge moments in trading, right? Price finally pushes out of a consolidation range, maybe above a key resistance level or below support, or through a pivot point like the source mentioned.
Absolutely critical moments. And checking the volume at that exact moment of the break is crucial for figuring out if it's likely a real move or maybe not.
So how does volume help there?
Well, if that breakout happens on high volume, you see that volume bar spike well above the average line, right as the price pushes through the level.
Then that's a good sign.
That's what the source calls a right or confirmed breakout. It's like the market shouting, yes, we mean it. There's conviction here. Lots of people are participating in this move beyond the old level.
Right. I definitely remember getting caught in fake outs early on. Price would just poke its head above resistance. I'd jump in thinking, here we go. And then wham, straight back down.
We've all been there. And that's often, though not always, a low volume breakout.
Okay. So if that breakout candle, the one that actually pushes through the level, forms on low volume, the bar is clearly below its average line.
The source correctly flags that as a potential fake breakout, a fakie.
Because there isn't that strong widespread interest or participation needed to really sustain the move.
Exactly. The conviction isn't there.
Yeah.
And often, the price just snaps back into the previous range, trapping those who jumped in. Volume gives you that vital confirmation layer.
That makes so much sense. And this ties right back into spotting potential reversals, too, using conditions 3 and 4 we just talked about.
Absolutely. That shrinking volume, while a trend is still technically going up or down, it's literally the market showing you, hey, the interest in pushing price further this way is fading.
It's an early heads up that the participants collectively aren't as engaged in that direction anymore.
Yep. Whereas conversely, when you see strong volume consistently accompanying a trend, like in conditions 1 and 2, that confirms the strength.
Meaning a reversal is less likely right at that moment because there's still high participation supporting the current move.
Correct. Now, the source also briefly touched on applying this logic to candlestick patterns.
Oh, yeah, like a specific pattern, say a shooting star or a hammer.
Exactly. If you see a potentially significant reversal pattern like that forming on your chart, checking the volume on that specific candle adds another piece to the puzzle.
So if a potential reversal candle forms, but the volume is really low, like way below average.
Then the reliability of that pattern might be a bit questionable. It didn't happen with much market conviction.
But if it forms with volume that's at least around average or preferably higher,
It adds more weight, more significance to that candlestick signal. It happened with decent participation.
it's all about looking for confirmation, isn't it? Building a case.
Precisely. The source hints at this too. You don't usually use volume in complete isolation. You might use it alongside other tools, maybe like a super trend indicator, as they mentioned.
So volume gives you extra evidence to either support or maybe question what your other indicators are suggesting about the trend strength or a potential change.
Exactly that. It's another layer of valuable information.
Okay, so pulling this all together, what does this really mean for you sitting there looking at a chart? What's the practical takeaway?
Well, I think understanding volume analysis gives you, it gives you a kind of market lie detector test. That's maybe a way to put it.
A lie detector, how so?
It helps you see if a trend seems genuinely strong and likely to continue, or if it's maybe running on fumes. It helps you spot those really tricky fake breakouts that are designed to trap traders.
And it gives you those early clues when a move might be losing momentum before a big reversal smacks you in the face.
Exactly. It's all about understanding the level of conviction and the level of participation that's actually driving the price action you see.
Okay, so quick recap then. Volume isn't just how much is traded. It's a measure of the interest, the engagement, the conviction of market participants.
And the key is always gauging its significance by comparing it to its recent average. Is participation higher or lower than normal?
And those four conditions combining price direction, up-down, with volume above-below average, that's your fundamental framework for interpreting what's going on.
That's your starting point, absolutely.
Okay, here's a final thought for you to mull over, building on something really fascinating that was sort of buried in the source material. We talked about how every single transaction has both a buyer and a seller, right? They have to exist simultaneously for the trade to happen.
Right. Two sides to every trade?
But think about their motivations. They could be completely different, couldn't they? The seller might be panic selling out of fear, while the buyer sees long-term value and is happy to take the shares. Or vice versa.
Yeah, absolutely. Everyone trades for their own reasons, with their own time frame and perspective.
So volume captures the sheer intensity of this simultaneous dance, this clash of differing motivations and perspectives happening at a specific price. High volume means high participation from both sides, whatever their reasons.
Okay, interesting angle.
So the question is, what else could observing these sudden spikes, or conversely, these sudden drops in volume and participation tell us? Not just about the trend's strength, but maybe about the underlying collective psychology. Is there a sudden shift in conviction, or maybe widespread fear, or maybe sudden opportunity seeking happening right at that moment, reflected in that volume bar?
That does add another dimension, doesn't it? Moving beyond just mechanics to thinking about the why behind the volume shifts. What's driving that collective behavior?
Something to think about, perhaps. Maybe start looking at those volume bars not just as data, but as a reflection of the market's collective state of mind.
Yeah, it's definitely worth observing with that perspective next time you pull up a chart.
Well, we hope this deep dive into volume analysis, based on the material you sent, has given you a clearer picture and maybe some really actionable insights you can start using.